Hello and a very warm welcome to the first in a brand new series of mobile money webinars. My name is Steve Clark and my team and I at Clarion Events provide the mobile money industry with a global portfolio of conferences, training courses, awards, newsletters and key stakeholder interviews. I'm thrilled that you've chosen to join us for this first webinar. At Clarion, we have a dedicated team of over 20 full-time staff who work exclusively on mobile money projects, ensuring that we have deep relationships with the industry and are able to provide the most pertinent and up-to-date news. I'd like to take this opportunity to say a word of thanks to our sponsor and partner, Microsave. We also host a dedicated MMT group on LinkedIn with over 5,000 highly qualified members. If you haven't joined yet, then I encourage you to do so. There are many discussions and news articles posted on there every day, so it's really worth checking it out. Today's webinar is the first in an ongoing series. Each webinar will cover a specific practical issue that mobile money program leaders and their teams will face as they deploy, roll out or upscale their service offerings. Have a look at the screen at the moment. You've got the dates of the next sessions on there now. So please make a note in your diaries and be sure not to miss out the next installments in this series. Today's webinar covers the integral issue of effective pricing models. Now, the challenge for any operator or financial institution is that their mobile money service must be priced in a way that will attract and retain customers, whilst also offering enough margin to justify the initial investment and the ongoing costs. I'm delighted that we can be joined today by two experts in this area, Graham Wright of Microsave and Ayaz Mehta, Director of Amaranth Consulting. Graham has extensive experience of supporting microfinance institutions with mobile money deployments, offering strategic and operational support, as well as assisting collaborations with other key stakeholders, including mobile operators and banks. In Africa, Graham sat on the steering committee that oversaw the design and testing of M-PESA, and in Asia, he had several teams working on E and M banking solutions for banks and MFIs. He has also worked extensively on training, systems design, research, and evaluation for the usual alphabet soup of donors. Ayaz has been successfully supporting mobile operators, MFIs, international banks, regulators, and vendors around the world in every aspect of their mobile money program deployments, as well as offering ongoing operational management and support. Previously, Ayaz directed M-PESA for Roshan, the leading mobile operator in Afghanistan. Thanks again to everyone that's viewing the webinar today, and I'll now hand you over to Graham.
Welcome to a discussion of pricing mobile money services. In Africa, people are used to paying to get access to financial services. Until a decade ago, ledger fees were absolutely common. I remember walking into a bank in Africa that had a savings product with the tagline or slogan, "Grow with us." And when Microsave performed the market research to understand why the number of account holders was so low and stagnant, we quickly learned that because of the ledger fees, which typically exceeded the little interest that was paid on the balances held, the product was known across the markets in the country as "Shrink with us." Most people prefer to pay transaction fees. They can see someone doing some work for them and understand that this costs money, and thus they need to pay for the service. But when they leave their money in an account and return 6 months later to discover that much of it has disappeared because of ledger fees, they get upset. After all, the bank has done no work for them and could have earned interest on their money if it was lent out. This cultural norm of charging for financial services is, however, one of the reasons that mobile money has taken off quickly in Africa. In Kenya, the lowest withdrawal fee for any of the accounts aimed at poor people, the ones with low minimum balances, is about 30 shillings, Kenya 30 shillings. So it's acceptable for M-PESA to charge 25 Kenyan shillings for a cash-out transaction. M-PESA agents are usually closer to their customers' homes or places of work, and agent shops are considerably less congested than most banks' branches. So this fee of around 33 cents offers, on a relative basis at least, real value for money. In the Indian subcontinent, by contrast, bank transactions are free, and always have been. Indeed, in India, the central bank recently mandated that all ATM transactions, whether on or off us, should be free of cost to the customer. This means that for many Indians, paying for financial services is an anathema, a completely new idea. But is it a completely unacceptable idea? Microsave recently completed research looking at the reasons for widespread dormancy in the no-frills accounts opened by banks at the behest of the central bank and government. Much of the problem was driven by the inconvenience in accessing the services because of the distance to the bank branches and the long queues once you got to the branches. On the basis of this, Microsave conducted a study on the cost people incurred to transact at bank branches and their willingness to pay for an agent-based system in their villages. Respondents were poor. 3/4 of them earned less than 5,000 rupees, or $111 a month. About half of them were illiterate, and about half were day laborers, selling their labor to survive. Respondents were chosen on the basis that they had a bank account. 40% of them visited bank branches twice a month, and 61% had an average transaction size of between 500 and 2,000 rupees, about $11 to $44. There are many and varied reasons why poor people do not like to visit bank branches in India. Almost invariably, at the top of the list was the amount of time that has to be spent in a bank branch to make a basic transaction. This problem has been made worse by the payments of the government's National Rural Employment Guarantee Scheme. These benefits are paid on the same day every fortnight or every month, and this results in excessively crowded branches. Another issue is the distance that many have to travel to get to the bank branches, which requires them both to spend money on transport and to lose valuable time that might otherwise be spent on income generation or important household activities. In addition, as is common worldwide, illiteracy creates barriers where transaction forms must be filled out, a problem often made worse by unhelpful bank staff. Other barriers to using distant bank branches include the risk of carrying cash, the cost of making the transaction, and indeed the very way that the banking system operates, which is not welcoming to those just making small transactions. The direct and indirect costs associated with traveling to a bank branch are not inconsequential. More than 70% of our respondents reported direct costs of more than 10 rupees, 22 cents, and indirect costs of loss of wage labor range from 50 to 150 rupees. That's $1 to nearly $3, and in some cases even more. In the light of these barriers and the financial and opportunity costs associated with branch-based banking, we should not be surprised that poor people are indeed willing to pay for agent-based banking services in their villages. The benefits that our respondents recognized immediately included the convenience and time that they would save, the lower direct and indirect costs of making transactions, elimination of tiresome traveling, removal of cash risk, an opportunity for women to save quietly without their husband's knowledge. Agent-based banking would also encourage savings and enable quick withdrawals for emergencies, and respondents look forward to easier interactions with local and trusted agents. "69% of respondents immediately agreed to paying fees for an agent-based service, and an additional 13% agreed to fees at the end of the discussion of the idea in the focus group." So, 82% of respondents say they are willing to pay for services that will reduce their real and opportunity costs. However, most were not willing to pay for deposit transactions, but they are typically willing to pay 1 to 2% of the withdrawal amount. And those that transact regularly want a fixed fee to reduce their costs. But of course, we should be aware that this is expressed demand, theoretical demand. How many would really pay these fees if they were introduced remains to be seen. There are concerns about agent-based systems that will also affect the willingness to pay in India and indeed worldwide. Concerns about security of savings deposited through agents is first and foremost. In India, many people have had bad experiences with private, unregistered groups and roving agents of financial institutions. Others are simply unwilling to pay for services that they currently get free in banks and from some financial institutions' agents. Some simply like the opportunity to travel outside the village. And of course, some live near the bank branch anyway and are willing to tolerate the queues. India is one of the most price-sensitive markets in the world. With traditional banking services offered free of charge, many observers were concerned poor people would be unwilling to pay for agent-based services. This is clearly not the case in the vast majority of cases. Poor people are indeed willing to pay for local, convenient, and friendly services. Furthermore, they are quite rational about the amounts that they might need to pay for such a service. A 1% fee on a typical withdrawal transaction of rupees 1,500 yields 33 cents, close to the rates charged by M-PESA. The challenge will be that if banks, as opposed to mobile network operators, offer agent-based services in the villages, the deposits to withdrawals ratio will rise. In Kenya, M-PESA does one deposit for each withdrawal, whereas Equity Bank's nascent agent network is already seeing 3 deposits for each withdrawal. Microsafe's research suggests that this is for 2 reasons. Firstly, the M-PESA wallet is seen as being too liquid and to encourage spending. And secondly, Equity is more trusted for savings because it is a bank. To cover the costs of paying agents, banks will either have to charge for deposits or look to make money on other services delivered through their agents, including from remittance and payments, selling insurance, and interest earned on loans. Pricing remains a challenge, but there are many opportunities.
Hello, my name is Ayaz from Amarante Consulting, and we are going today to look at an overview of international approaches for mobile money pricing, hoping that I will have some information of value to be sharing with you today. First of all, before we start talking about the pricing, it is very important to understand who is the customer that we are talking about. And very often when we refer to customers, we generally refer to the retail consumer that we are going to be targeting with mobile financial services. But we have to keep in mind that there are other types of customers too. For instance, agents are actually going to be among the first customers of mobile financial services because agents are going to have an account open with you and they are going to be at the corner store of any services that you're going to be offering to the retail consumers. And therefore, agents, because they are so key to the success of the service, are probably one of the first customers that mobile financial services providers will have to be focusing on. And usually, the product offering for agents will include airtime top-up, money transfer, bill payments, deposits of cash, withdrawals of cash, and of course some form of retail financial services. Another important category of customer is going to be the participating entities and the institutions that are going to be part of the ecosystem. I'm referring specifically to businesses that are going to be paying payrolls using your mobile financial services, government agencies that are going to be paying subsidies using your mobile financial services, all sorts of entities, businesses, organizations that you are going to be contracting with to use your mobile financial services platform. These entities are actually going to be crucial to the adoption of mobile financial services in your markets, and therefore they're also going to be very important customers. And of course, as I said initially, the retail consumer. Usually a typical product offering for retail consumers will consist of airtime purchase, mobile money transfer in a typical person-to-person transfer scenario, bill payments, of course cash in and cash out, and all sorts of other services as well. Well, what comes across the current slide is that the value proposition for these different types of customers may actually differ from one customer to the other. What's going to be mattering to the retail consumer may not be exactly what matters to the agent and what matters to the other participating entities in your financial services. What is important to understand, though, is that there are some common factors that are important elements of the value proposition to these different types of customers. And those common elements are convenience, and we are going to talk about what convenience means. They are about pricing, and we are going to talk about pricing and lower transaction costs. The third element of value proposition is the security that you're going to be offering through your service. And of course, the fourth element is going to be the ease of use and the simplicity of the service. Now, why do we talk about those four elements in a pricing webinar? Because all these four elements are going to be playing a significant role into how you're going to be pricing your service to the end customer, whether that customer be a retail consumer, that customer be an agent, or that customer be any kind of organization that's working with you. So let's start with the consumer piece and the convenience piece. What does convenience actually really mean? Well, convenience can be about many things. Convenience can be about how long, for instance, someone has to wait at a bank or a utilities company's office to perform a financial transaction or to pay a bill. For instance, if you look at the situation in Haiti right now, people have to wait for something like about an hour in a bank branch, outside of a bank branch in the sun, before they can actually enter into the branch and undertake their transactions. If you look at the situation in Abidjan in Ivory Coast, people sometimes also have to wait for a long time in long lines outside the utility branches to pay their bills. That's a question and a problem of convenience given to the customer. Convenience can also be related to the distance or the time that a person has to travel to be able to perform a transaction or to pay a bill, for instance. So to give you an example, in urban areas and big urban centers like Mexico, Sao Paulo, or Jakarta, customers, because of the very heavy traffic, will have to travel for hours to reach any physical place, be it a utility company office or a bank branch, to be able to perform a transaction. There again, it's a question and a matter of convenience. And of course, no wonder that bill payments have been a major driver of customer adoption of branchless banking in Brazil, in addition to La Bolsa Familia, because branchless banking has enabled these customers to cut down and save on the travel time required to go and make a transaction. Now, a recent study that was conducted by McKinsey has showed that low-income households in India want to have quick access to their funds. There was a study that was conducted with 546 Indian financial services consumers in October of 2009, and what the study has shown is more than 50% of these unbanked have actually considered using banks for financial services, but only half of them have actually done so. And what the survey explores is the reasons why those people didn't actually go to the bank to use the banking services. And as you can see in the top 5 reasons, of course there's a question of pricing to start with, or let's say a question of requirement. The minimum balance that the banks are requiring is too high. The second reason is that the bank personnel doesn't give sufficient attention to the customers, and of course for an unbanked customer that's not used to using banking services, it's going to be crucial to receive the right amount of attention and guidance and hand-holding and information. The third element is that the bank is too far away, and that is somehow related to the convenience factor, because the agents that you are going to be rolling out to serve the clients will have to get as close as possible to the local communities that they are going to serve, therefore minimizing distance, travel expenses, and cost to the customers to access the service. Of course, there's a question of customer education and the question of accessibility of funds and the ability of customers to take out money very easily, which again refers to the proximity of the agents and the convenience. And all of this, of course, has a cost implication to the client and is going to be important in terms of reducing the cost to the client. So what is the impact of a distance in your value proposition and the convenience offered to the end users? There was a study that was made by IFC in an Asian country that has tried to estimate the relationship between the distance that individuals are willing to travel to perform their transactions and the amount or the value of the transaction. And what the study has shown is that the willingness of a customer to venture far from home to perform and undertake a financial transaction is going to decrease with the size of the transaction. And therefore, what we can say is that there is obviously a direct relationship or a direct correlation between the distance that a customer is going to be willing to travel and the size of the transaction. And that, again, is a very important factor to take into consideration when you're going to be designing the convenience elements of your value proposition. And of course, all of that has value in the eyes of the customer and therefore can be factored into the pricing that you're going to be designing for your customer. Now, this being said, and having spoken about convenience, we should recognize that pricing, of course, among all the different factors and all of the different value proposition elements, is the one that is going to have the highest impact on the decision of the customer to use the service. And of course, the cost of the service is going to be a major, major driver of success of your mobile financial services. In Kenya and South Africa, for instance, M-PESA and Visit were considered to be much cheaper than traditional banking channels. If I recall properly, 70% of the people who were interviewed claimed to be using Visit services because they thought Visit was cheaper than the other offers available in the market. And therefore, that has made pricing a significant driver for adoption. In Cambodia, where mobile-based payment services have been a little bit less successful, the person-to-person money transfer did not really take off because people already had a variety of options available in the market to transfer money throughout the country domestically. There's a large number of foreign exchange brokers that offer the service for only $1. So in that particular context, whatever the price you're going to be applied for that service, even if you're going to charge it 50 cents, it's never going to be considered cheaper enough by the clients for them to decide to change their behaviors and start adopting the new service. And therefore, it's very important to take into consideration the existing offerings available in the market and the existing alternatives that the customer are going to use when you set your pricing structure. Pricing, of course, also has to take into account all costs to the customer. So we're not only comparing ourselves with the other existing alternatives, but we need to take into account the opportunity costs to the customer to access the service. So for instance, if a customer is going to have to travel for 3 hours and maybe spend $1.50 in bus rides to access your service, that customer is probably going to be more willing to use your mobile financial services and possibly even pay a little bit more if that's going to save him some time compared to other alternatives. So again, take into consideration the full customer experience, not just the transaction costs, but also the traveling costs and the time that is going to be spent to access the service. And finally, promotions are also a very useful tool to drive customer uptake and often serve as a boost for transactions. So for instance, if you look at what's happening today in Haiti with Voila, or what Tigo is implementing in some of their operations, or services like Oipago in Brazil are implementing as well in some of their operations, is that they're actually giving airtime free of charge to customers who are using their mobile financial services to transact. And therefore, when you start giving an airtime bonus to customers who are transacting, you're virtually making the transaction free to the customer, because whatever fee they're going to be charged is going to be offset by the amount of airtime you're giving them. Now, of course, that type of scheme can serve as a booster and cannot be implemented on a permanent basis, because there's obviously a cost attached to it. But in the initial stages of your launches, it can really act as a significant driver for customer adoption and be a significant push to the use of the service. Now, if we look into pricing in a bit more detail, first of all, it's very important to identify in your value proposition an anchor product. In Kenya, that anchor product was domestic transfers from urban centers where the breadwinners have moved in hope of better job opportunities, and from where they have been sending money back home to support their families in rural areas. In Uganda, it's also been about domestic transfers, but probably more from rural areas to urban centers, with parents paying for the school fees of their children. In Ivory Coast, the primary product or the anchor product has been about bill payment. In Thailand, it's been about easy payment of and subscription to True Money's content, internet, and digital TV services. In the Philippines, it was about international remittances. So I'm telling you this to make you realize that depending on the market in which you operate, the nature of the anchor product may be very, very different. But what's very important is to implement competitive pricing to encourage the uptake of the anchor product. So for instance, if you look at Vodafone's M-PESA or MTN's implementation in countries where their anchor product was about domestic remittance or domestic money transfer in a person-to-person scenario, and when you compare and benchmark their prices or the cost they're charging to the customer for performing a domestic transfer, it's usually 20% cheaper than the other alternatives available in the market. So you need to, again, set a competitive pricing to encourage and drive the uptake of your service. Secondly, think about registration. Registration is something that should be easy for the customer to perform, and it's generally free of charge, and deposits are free of charge, because again, you want to incentivize the customer to start putting money into the system without introducing any other barrier. There's only a few cases that I have seen or I have come across where there are charges for registration or for cash-in. For instance, Visit is charging $5 for registration. Smart in the Philippines is charging $1 for the debit card that can be linked to your mobile wallet. And Zap in Kenya is charging for cash-in services. And we're going to talk about why they're doing so. a bit later in the presentation. Now let's look a little bit into the pricing structures that are available. Obviously, there's different ways of defining your pricing structure. If you look at the box in the bottom left-hand corner, subscription, there's 4 types of pricing schemes that are being described. Let's start with the subscription fee. The subscription fee is basically a fee that you're going to charge the customer for the customer to use the service and perform as many transactions as they want. Well, that's not very customer-friendly or customer-focused because it sets a price independent of how much the customer is going to use the service. On the other hand, of course, it is likely to drive volume if the customer has already paid the subscription fee. You also have the fixed percentage, which again is not a very customer-focused or customer-friendly scheme because it's generally more difficult for a customer to understand in a lot of developing countries, and that's something that you will only find out through proper market research. We often assume that because Western Union, for instance, is applying charges sometimes based on percentages of the amounts being transferred, we often assume that the recipient in a developing country is going to be understand the percentages. Well, we did a research and a study in Afghanistan when we were about to launch M-PESA, and we realized that people had no idea at all about what a percentage means. And so for a customer to figure out how much you're going to be charging them if it's based on a percentage of the value of the transaction is going to be very difficult. Now you have 2 other schemes that are probably a bit more relevant in developing economies. There is the flat fee structure, which is very customer focused and very friendly because it's a very simple fee to understand for every transaction. And of course, as much as it's easy to understand, it may not necessarily be driving volumes in the high-value transactions or in the low-value transactions. So it's very easy for the customer to understand, but it doesn't give you a way to influence customer behavior in high-value brackets or low-value brackets. The tiered structure, on the other hand, allows you to do that. It's more customer-focused. It allows you to influence customer behavior in different tiers or different brackets, depending on the volume of the transaction. But of course, it introduces a new level of complexity that's more difficult to communicate to the client. And the communication of the pricing to the client is going to have to be written, provided through brochures, leaflets, visuals that the customer will be able to see, but it will also be more difficult to remember. The box in the bottom right-hand corner compares the pricing approaches implemented in 12 different implementations in emerging markets that were studied by the CGAP and by the Amarante consulting team. And what we see as far as cash-in is concerned, that in 57% of the cases, which is a large majority, the cash-in was offered free of charge to the customer. What we also see is that the cash-out has been mostly charged on the tiered structure basis for 57% of the cases, and in 29% of the cases, the cash-out was charged as a flat fee only. If you look at peer-to-peer as the most important, I would say almost foundational service in a mobile service, financial services proposition, in 64% of the cases, the P2P was charged as a flat fee, and in 29% of the cases, the P2P was charged based on a tiered structure. And then finally, bill pay by far in the majority of implementations is usually charged as a flat fee and usually charged to the billing entity or the biller or the utility rather than to the payer. Let's look into a benchmark, which is a case study that we have done based on some research that was done by CGAP. And the use case basically consists of a client cashing in $68, topping up airtime for himself for about $4, paying the fees for the cash-in, for the top-up, for the transfer, and the cash-out, which is $2.44, and ultimately transferring $62 to the recipient. So we're talking about, again, a client A that cashes in $68 and that at the end of the day is going to be transferring $62 out of the $68 after removing the charges and the value of the airtime top of that customer A performs for himself, is going to be transferring $62 to customer B. And we've been comparing the cost of transferring those $62 and cashing them out across a number of implementations in Africa and Asia as well. And what you see in the bottom chart is a comparison of the cost in US dollars that ranges from 26 US dollar cents to 2.4 US dollar cents, depending on the implementations for the end-to-end use case of the transfer of these $62 with an initial cash-in of $68. Now, that gives you a benchmark to compare yourself against those different players and see where you actually fit in that picture. So we essentially provided you with this chart as a sort of a point of reference for you to be able to measure yourself and see where you are. Now, let's look into some of the examples of P2P pricing, person-to-person domestic transfer. Well, first, a few comments. The pricing that you are going to be applying will be influenced by many factors. The first factor is probably your market position. Of course, if you are going to be the largest player in the country, and if you are the first one to launch, your pricing strategy will not be the same as if you are the smallest player to launch or a late entrant in the market. For instance, if you look at the pricing that Safaricom has been applying in Kenya for person-to-person transfer from a registered user to a registered user, they were charging at the beginning 38 US dollar cents for amounts of up to 450 US dollars. Now, if you compare that with what Zain has been charging in Kenya for a transfer to a registered user, Zain has been charging 13 US dollar cents, which is almost one-third of what Safaricom was charging. Well, of course, in the case of Zain, they had to be extremely aggressive on the pricing side because they were the second one to launch, and Safaricom already had millions of customers using the service with a 75% market share in the market. So in that particular context, the pricing strategy of Zain was really driven by aggressiveness and competitiveness to be able to be attractive enough to customers when their value proposition in terms of size and customer base was much weaker than M-PESA's value proposition in the market. The second point I would like to highlight here is that your pricing will also be influenced by your acquisition strategy. Of course, Safaricom quickly identified that the decision over the choice of the channel for a person-to-person transfer was going to be made by the sender in Kenya. Also, they have decided to implement an asymmetric pricing approach where to send money to a registered user costs you a lot less money than to send money to a non-registered user. If you look at, again, the cost of transferring money to a registered user with M-PESA in Kenya, the cost was, as we mentioned, 38 US dollar cents for amounts of up to $450. Now, the cost of transferring the same amount to a non-registered user would vary between 95 US dollar cents and $5, which puts a lot of pressure on the non-registered user to actually register to the service, and that pressure is going to be applied by the sender. And therefore, Safaricom has decided that the sender was going to push for the non-registered to register to the service, and that was their acquisition strategy. And that has significantly influenced, as you can see, the pricing structure that they have implemented. Now, how low of a transaction do you want to capture? And that's probably the third element that's going to be influencing your pricing structure. For instance, if you compare M-PESA's approach in Kenya and M-PESA's approach in Tanzania, you will see a lot of differences. If you look at the cash-out fees that are going to be charged to the user, you see that in Kenya, the user is going to be charged from 32 US dollar cents to something around $2.16 for amounts that are going to range from 32 US dollars to 250 up to 450 US dollars. If you look at the same case in Tanzania, you actually start charging the user 11 US dollar cents for amounts as low as $3.71 up to 2.67 US dollars for amounts that go up to 371 US dollars. what we see here is that the brackets are much, much lower in Tanzania because M-PESA in Tanzania wanted to address and capture much lower transaction values because of the difference in economic levels, but also because of a significant difference in the business approach. And M-PESA in Tanzania has been targeted much lower value transactions and therefore have defined tiers and charges that are much more relevant and granular in these low value transaction tiers and brackets. And this is again a very important component of the pricing strategy that you're going to be implementing. The last element that I would like to mention is your approach towards cash-in strategy and how that is going to be influencing your pricing structure. If you look at the Zain's case in Kenya, Zain has launched 2 years after Safaricom, and their problem was much more, or the challenge was much more to acquire merchants and agents than really convince clients. The convincing clients part was addressed by what we discussed earlier, which is a much lower fee for peer-to-peer transactions, almost a third of the fee charged by Safaricom to be able to attract customers. But they also wanted to implement a push approach, even more so than a pull approach. And in that particular push approach strategy, they had to acquire a number of agents and give agents sufficient value to incentivize them to go after the clients and register the clients. And in that particular case, what Zain has decided to do is to pay agents more for agent services. And the services that agents are going to be providing are cash in and cash out. If you want to pay agents more for cash in and cash out, you need to get that money from somewhere, and eventually Zain decided to charge customers for cash in, which is one of the few implementations where you see that customers are actually paying money to deposit their money into the system. And in the case of Zain in Kenya and Tanzania as well later on, Zain was actually charging anywhere from 15 US dollar cents to 74 US dollar cents for a cash in and a deposit of a client. So these are really elements and approaches and I would say factors that really come into play and come into consideration when you define your pricing strategy. Now, the last element I would like to mention on this slide is, of course, you can also play, as I mentioned before, on promotions to influence price perception. If you're going to be charging a small fee for a person-to-person transaction, but for every person that performs that transaction, you're going to give some sort of airtime bonus as a reward for transacting, of course, that's going to influence the price perception because virtually the transaction is going to be free of charge for your client. And these tools are very important to use, but also to use with a lot of discernment because at the end of the day, you don't want to be subsidizing all of your mobile financial services transactions giving free airtime. First, because it would be treated as an uncompetitive practice in the market, but secondly, because it's going to make your mobile financial services a non-viable business. One element that I would like to mention here, without spending too much time on it, is the importance when you define your pricing structure of understanding client behavior. And the table that you see on that slide gives you the example of a client behavior in the case of Safaricom in Kenya. And that comes from a survey that was performed in 2008 across 3,000 households. Well, if you haven't done that survey, if you haven't done a thorough market research in your particular environment, it's very, very difficult to understand what the customer behavior is going to be, and therefore it is going to be difficult to anticipate and define a pricing structure that's going to be consistent with that user behavior and that's going to be relevant for your business case and make your business a viable business. So my main message here is when you design your pricing structure, make sure that you have performed a thorough market research to really understand what your customer behavior is going to be and what the pricing structure that you will define is going to have to be accordingly. Now, let's continue and carry on with the other convenience or let's say the other value proposition elements. We talked about convenience, we talked about pricing. I am probably not going to talk about security because that's a pretty straightforward element to understand. The fourth element of your value proposition is going to be ease of use. And the few points that I would like to mention in the area of ease of use are customer registration, which obviously needs to be very easy and is a significant driver for customer adoption and customer success. I would invite you to refer yourself to Safaricom's customer registration process, which is one of the easiest that you can see in the market today. But there's other registration processes that are even easier in Haiti, for instance, where a customer that's already been KYC'd by the mobile operator can directly self-open a mini wallet with much lower restriction and limits in terms of the balance and the volumes of transactions and the values of transactions that they can perform, but they can open that almost directly online from their phone without any human intervention. So there's a number of customer registration processes implemented today that really simplify the life of the customer and make it easy for the customer to register. Secondly, customer education. Customers need to be continuously taught about how to use the service and continuously reminded of the benefits of the service. And in educating the customers, consider your agents as being your face to the customer and probably being the primary channel that you're going to use to show the customer how to use the service and how to educate the customers. Therefore, it's very important to train the agents not just on performing mobile financial services, but also on providing basic customer services to the end consumers, and in particular training them. Of course, the marketing is very important as well, and the simplicity of the message is going to significantly impact customer understanding and customer adoption of the service. As an example, Safaricom's peer-to-peer transfer was marketed as send money home, which is a very simple message, very straightforward. And even if Safaricom was offering bill payment and airtime top-up at the same time, they only marketed M-PESA as the send money home product. And that simplicity corresponding to a specific need in the market, it was what has really driven the adoption of the service. And finally, you need to design the right customer experience and, of course, give customers control and let them use the product and the service as best suits them. And you need to provide the right level of incentive to the agents because, again, agents are going to be your primary clients and they're going to be at the cornerstone of any mobile money project. Agents are going to be the building foundation for your service. They are going to be very often the reason for success of failure, and we have seen a number of failures and relaunches in the market because the commission structure and the value proposition to the agents or the pricing to the agents was not designed properly. So you need to give them the right incentive and design the right structure for them. And finally, I would like to conclude this presentation by showing you an example or a few examples of agent pricing or agent compensation models. And the elements that usually are factored in an agent compensation model are going to be registration bonuses, because you need to provide the agent with an incentive to register customers and get customers, attract customers to your service. And that's done in the form of a registration bonus. Of course, cash in and cash out fees to compensate the agent for the services that the agent is going to be working on. And there could be some extra benefits or additional benefits that can be added to this equation. You will see in this chart examples from M-PESA in Kenya, from ZAP in Kenya, from MTN in Cameroon, from MTN in Benin, and from M-PESA Vodacom. What is important to highlight here is that when it comes to the registration commissions or the registration bonus, they can be paid all at once in one go when the agent registers the customer, or it can be paid in 2 installments. The first installment when the agent actually registers the customer, and the second payment happening when the customer performs the first event. That event can be, for instance, loading of the mobile wallet for the first time. And that will enable you to push the agent and give more incentives to the agent, for the agent to push for customer usage and customer activity. Because one of the biggest challenges that we see right now in mobile money implementations beyond customer registration is customer activity and the level of dormant customers. If you're going to start splitting the commissions given to the agents between registration and then at the first event or the first activity that the customer performs, you're going to be driving usage, and you're going to be using your agents to actually push customers to be active customers and to transact. There's some models that have been discussed where agents are even going to be receiving commissions on the transaction fees charged to the customers when they perform transactions if these customers have been registered by a given agent. Well, that's almost a revenue share kind of mechanism with the agent, and I would probably consider that kind of scheme if I was a third or a fourth player launching in the market, if I really wanted the agents to be very, very active and involved in pushing for customer usage aggressively and continuously and consistently. The other element or the other point I would like to sort of emphasize on the registration bonus is you really have to be ready to understand, and be ready for and prepared for the cost that you're going to be incurring by implementing that type of scheme. For instance, just keep in mind that let's take the example of Safaricom. Safaricom has probably 16 or 17 million customers today. Well, just imagine that if they have paid every single agent $1 to register that customer, that means they were willing to put $16 to $17 million on the table to get that customer base. So what I'm just trying to say here is while designing the bonus given to agents, you also have to be sure that you have secured the budget, that it's in your business case, and that you're very well aware that if you want to have a 1 million customer base, you're probably going to have to put $1 million on the table in commissions to agents for them to register these 1 million customers. The second challenge that we see very often in agent compensation models design is the challenge of the airtime revenue cannibalization, because you're asking agents to register customers that are going to be performing a number of financial transactions directly from their mobile phone, including self-top-up. Now, the challenge of cannibalizing the airtime revenue of agents can be addressed by providing the agent with a commission on every airtime purchase that's going to be made directly from the phone by a client or a customer that particular agent has registered. And usually when there's some sort of resistance from the agents to register customers in the different markets, because they're very well aware that those customers are going to start buying airtime directly without going to them, that's one of the arguments that is very, very effective in trying to circumvent the problem and show the agent that irrespective of where and when a customer is going to be doing some self-top-up, if that customer has been registered by that particular agent, the agent is going to be receiving a commission. There's other type of elements that can also be built in the agent compensation model, which is the speed of settlement, whether the settlement is going to be online or offline, some additional bonuses or additional commissions on targets achieved, on certain volumes of transactions managed, on a level of quality of service provided. There's a different number of ways to design an effective agent compensation model that's going to go hand in hand with your customer pricing model. Well, this is where my presentation is going to end for today. I hope I've been able to share in that very limited time some valuable information with you, and of course we'll remain available to answer any question you may have or provide you with any extra or additional information that you may require. I wish you all the success in designing your pricing schemes and with your mobile financial services. Thank you very much.
All right then, so now we're at the question and answer phase of this webinar, and my name is Graham Wright, and I are going to respond to several of the questions that you posed either before the webinar itself or during the webinar. And I'll ask Ayaz if he will be kind enough to take one of the questions that he selected to answer.
Yes, hello everyone. We've received, as Graham mentioned, a number of questions, and I would like to address a couple of them on my side and leave Graham to answer also a few questions. The first question that I would like to answer is a question about the sustainability and viability of the mobile money agent. I would just like to make a couple of comments on this. I think there are two aspects involved in ensuring the viability and sustainability of the agent. First of all, there is the level of income that you can actually ensure for the agent to make sure that the business makes sense for the agent. And the second is the viability of the agent for your business. So let me just quickly talk to the two topics. In terms of level of income that you can guarantee, of course, the agent remuneration being mostly based on commissions derived from transaction fees, you have to make sure that there is enough activity in terms of transactions at your agent. And of course, that sort of depends on the design and the density of your agent network. Just to give you a few benchmarks that we have seen across multiple countries, from Kenya, where it's purely a mobile operator play, to countries like Peru, where it's purely a bank play, a reference point of 80 to 100 transactions per day managed by an agent should actually make it work for the agent in terms of commissions received. And of course, you can always add additional incentives to that, such as commissions on airtime and other type of incentives that you can add on top of the transaction fees. And that has to be consistent with the existing business structure of the agent and the existing margin. So if you look at agents that make 5% commission on airtime top-up distribution, probably that level of transactions is going to give them enough compensation to make them interested and would be competitive enough versus the airtime business. If you have agents that perceive 15% commission on airtime distribution, then of course you might need to look at additional incentives to increase the level of compensation that the agent would get. That's on the level of income side and aspect. Regarding the viability of the agent for your business, of course you have to provide a number of support functions for cash supply, for liquidity management, etc., but also put in place a number of controls to make sure that the agent is performing well and pay regular visits to the agents, look at their needs, understand what their problems are, what their challenges are and issues are going to be, to provide them with the best support possible. So I would say the definition of the commission structure and the setup and definition of an agent management organization are going to be the two pillars to ensure viability and sustainability of your agent. The second question, before I pass it on to Graham, is something related to the threat to pricing in the future. I would say, of course, the threat to the pricing is going to be increased competition, because at the end of the day, even though a number of players have a first mover advantage in a number of countries, very soon the mobile money, or let's say mobile financial services infrastructure, is going to become commodity. And when it becomes a commodity, I don't think there's going to be enough money to be made from pure payment transactions or consumer payment transactions as person-to-person transfer, for instance, because that value will start eroding in the market, and then you will need to compete based on increased convenience, based on diversification of products and services, because obviously the more products you offer to your clients, the increased their stickiness will be. And looking into pure financial products like micro-lending, like micro-insurance, for instance, or even micro-savings, you're probably going to be able to derive much more value and much more revenue from the clients than purely transactional services. And therefore, the erosion of the pricing on the transactional services will have less impact on you if you start offering more core financial services to the clients, and I think that's going to be very important. And of course, you can always use promotions to change price perception as well. So for instance, a number of players today are charging a small fee for person-to-person transfers, but are giving free airtime to consumers who transact. And basically, if you give as much airtime as you would charge in terms of fee for the transaction, virtually the price to the customer is going to be zero, but then you're still charging a fee and giving something else in exchange that might cost you less than the actual money that you would lose by decreasing the price. So there's different ways of doing this, but my firm belief is that in a couple of years from now, the infrastructure for for transfer services is going to become a commodity. Prices are going to erode. And at the end of the day, it's really on value-added core financial services that you will have to differentiate, innovate, and compete. Graham, the floor is yours.
Thank you. I mean, just to reiterate what Ayaz has just said, I think it's the shelf life of charging the sort of fees we see currently in the marketplace worldwide for basic payment and remittance services is very short. As mobile money becomes more and more common, I think that those prices will be significantly eroded, and offering other value-add services, and particularly financial services, will become tremendously important. And this is why, in some respects, although the banks, a few banks outside Latin America have been very active in this arena, I think we'll see that change over time, because it is offering a range of financial services across mobile platforms that will create the real value add for both customer and the bank offering them. So turning to some of the questions that came in before the webinar, one of the questions that we were asked was how do pricing models and customer willingness to pay differ across global regions and for differing levels of socioeconomic target markets. And in part, it seems to me that this depends on what the conditions precedent were before the mobile money platform was rolled out. So as I think both Ayaz and I alluded to in our presentations, in Africa it's a lot easier to charge for a lot of these transactions simply because people are used to paying withdrawal fees at banks. Whereas in the Indian subcontinent, that has not been the case. And so there were significant concerns and indeed, these extended into the Reserve Bank of India itself, that poor people would not be willing to pay for financial services delivered through either E or M banking systems. As I said in my presentation, that's quite clearly not the case, because the inconvenience of transacting for free in a bank branch is so enormous that people would happily pay for the convenience of a local agent-based system. And I think in terms of socioeconomic target markets as opposed to geographic, really the issue here is that more affluent people deal with larger amounts of money, and therefore small commissions, are usually on a flat basis, will be much more acceptable. Tiered commissions you need to look at a little bit, because clearly you don't want to have too much leveraged off a larger scale transaction. And that's why pure percentages for higher socioeconomic classes, percentage-based commissions really are quite often simply unacceptable. So really, the higher the socioeconomic class, the more likely they are to have existing internet banking options and so on. So you really need to factor that in also when you're looking at what pricing you can reasonably expect the better off people to pay. The second question that we also had was, is the customer aware about what opportunity cost means? For example, are they willing to pay a tariff instead of investing 1 hour of their time in transportation in order to pay a bill? And my experience in many countries across the world, and Microsave has now worked in about 10 or 12 different countries on this very issue, consistently people fully understand opportunity cost, but we need to recognize that the opportunity cost varies across different markets and different socioeconomic levels. So if I'm a rural laborer and it's not harvest or sowing season, it's quite possible that the opportunity cost of my time is relatively low. But if it's harvest time, the opportunity cost of my time is very high because I could be out there earning money, bringing in the harvest. So, that varies, opportunity costs and what it really means varies significantly across occupation, time, and indeed socioeconomic group. But consistently, people are remarkably savvy about the value of their time. Finally, the third question that I was asked was, how do you think it would work to price low initially, say for an introductory period, to get experimentation and high take-up? And this is something that I think one wants to approach with some caution, simply because from a marketing point of view, it is terribly, terribly difficult to raise prices significantly after you've got people onto a platform, simply because they feel that you've sort of misled them and cheated them. I think that perhaps better options are to offer the first X number of transactions either at a discount or for free. I know that our experience is typically that people need to do 4 to 5 transactions before they begin to trust the system properly and use it regularly. The other thing the other sort of pricing decision that needs to be made very carefully also is what sort of support service pricing might look like. And what I mean by support service is balance inquiry, with a very high proportion of transactions at the beginning of a mobile platform rollout are all about balance inquiries, people checking time and time again, is the money I deposited still there? Checking it again, is it still there? And the other one, of course, is call centers, because we've seen across the world that call centers get flooded with calls asking about a wide variety of things, many of which could probably be dealt with more cost effectively. And so I've seen some mobile money providers actually introduce charges for call centers because they were being inundated. And so they wanted to actually sort of reduce the inflow to call centers. That again, you need to be careful about that because, of course, if people feel that it takes a long time to get through to the operator in the call center, there are endless IVR, choices you have to make, which, 1, 2, 3, or 4 push button, 1, 2, or 3, or 4 all the time, and only after 10 minutes of battling through an IVR system do you actually get the answer to the question you need, and you're charging people on a time basis. They'll get very bent out of shape and they'll be understandably upset. We all dislike IVR at the best of times, much more so when you're being charged on a time basis. So where charges for call centers have been introduced, they're usually on a per call basis rather than on a time basis. So I think those are the questions I have. Ayaz, are there any others that you would like to answer from your side?
Well, there's just a question that was asked during the webinar regarding the primary reasons that non-users have expressed for not adopting mobile money transfer. I would say definitely not the cost of it, because usually mobile money transfer or mobile financial services are priced very competitively against existing alternatives in the market. So the cost element is surely not the primary driver for non-adoption. I think it's more a matter of customer education and financial literacy. That also, of course, plays into the level of trust that customers are going to have into the service. And sometimes the complication of the service in terms of how it's been designed and the levels that the customers, levels of menu that that the customers have to navigate through. But I would say definitely the financial education and the trust would be the first element from the markets that we've been working in. And the second aspect that I would like to emphasize is also the fulfillment of a primary need and the importance of definition of an anchor product. Very often mobile money service providers or mobile financial services providers go to market with a P2P offering as the primary service. And again, that sort of re-emphasizes for me the importance of performing detailed market research to really understand who the unbanked are, what their needs are, and what their main constraints are today in their current context. Because in certain, and as we mentioned that before, Graham as well as myself, in certain countries, peer-to-peer has been the primary product and the killer application, let's put it this way. But in other markets, it's been about bill payment. In other markets, it's been about receiving government subsidies. So again, that's also sort of contributed to non-adoption whenever the service that was provided was not totally in line with the most important pain area that the consumers were facing. So that's just the comment I wanted to make about that question. There's been another question that I would like to take as well before I pass it on to you again, Graham, is the question regarding the profitability of mobile money projects. Well, it depends on the perspective that you take on it, whether you're going to be a bank, whether you're going to be a mobile operator, or whether you're going to be another player in the value chain. But I would say if you look at the mobile money business on a standalone basis as just a financial service that's provided to the market without looking at all the ancillary benefits around it in terms of churn reduction, for instance, for a mobile operator. If you really look at the mobile money business on a standalone basis, there's very, very few projects that I know around the world that are actually profitable. I would say M-PESA, Safaricom is probably one of the very, very few, if not the only one, and it took them many, many years and the achievement of a certain customer base. I believe they turned profitable when they reach about 9 million customers. And that shows you that the mobile money business is really going to be a volume business because of the very low value transactions and the very low charges. So, and because you have to invest upfront a lot in marketing, customer education, and in building the agent network. Therefore, I would say unless you are sure to reach a significant volume of transactions and customers in the market, it's very difficult to make a pure money transfer business viable at a domestic level because of the very low margins. What's going to make it profitable is adding new layers of services, as we mentioned before, in terms of course, credit, even though I believe savings is much more valuable to the customers, but in terms of credit, in terms of micro-insurance and other types of services like institutional payments, G2P payments, payrolls for informal payroll recipients, institutional transfers that you can normally charge at a higher price. For instance, if you look at the average cost around the world that it takes the government to disburse a G2P payment, the average cost of the transaction to the government is going to be $5 per transaction, whichever mechanism is going to be used today to disburse that G2P payment. Now, if you're able to charge a government a fee of $1 or $2 to render that service, of course, that's going to make your model much more profitable. So again, it's really additional services that are going to be making that service profitable, because the more the market matures, the more the prices are going to be under pressure on the transfer business, and you need to start innovating and introducing new services that are going to require very strong partnerships between financial institutions, mobile operators, governments, and other stakeholders in the ecosystem. Graham, do you have any other questions you'd like to comment on?
Yeah, I would just amplify what you said around M-PESA. I mean, M-PESA is now profitable with massive numbers, and this is because essentially it remains a mono product. It remains a remittance stroke payment system. And this links back into something that I think is also very important, is I had always assumed with the M-PESA pricing structure of deposits are free and withdrawals or transfers are charged, that people would start saving significant amounts of money on the M-PESA system. Just keep putting in small amounts, small deposits for free, building up a larger lump sum. This has not happened, and we did some research recently to look at why, and there are two reasons. The first is that a wallet on the phone is perceived to be too liquid. It's now, because M-PESA is so pervasive in Kenya, it's too easy for people to spend out of that wallet on their phone. So it's perceived to be too liquid. It's therefore not a savings account per se. It's a transaction account that they have. And the second component of it is that Safaricom is still viewed as a communications company, as a mobile network operator, not a bank. And therefore, viscerally, the people of Kenya don't trust it with large amounts of savings money. And I think that it's ironic that banks have been slow into this market. The potential for them is phenomenally large. That said, you can, we've just finished a couple of briefing notes that are available on our website examining why banks don't get into this business. And really, in realistic terms, both in Asia and Africa, and I suspect in Latin America as well, the rapid growth of the middle class allows them to continue their traditional banking models and make ever-growing profits anyway. So perhaps that's a reason why we don't see banks rushing into this more complicated, more players, more collaboration, and massively higher volume market, because frankly they can make bigger margins with their traditional form of business for the more affluent. But eventually, I sincerely hope and indeed believe that banks will get into this simply because they hold the key. The range of services that they can offer hold the key both to really effective, high-quality financial inclusion and also to making mobile money platforms sustainable at lower number of customers. I think with that, we will declare a truce and wrap up this first webinar. We'll be running another webinar. Clarion and Microsave will be running another webinar in about a month's time. I hope that you will all sign up for that. And please rest assured that the webinar and slides will be made available. And Clarion will be in touch with all of you who signed up for this webinar to tell you how to get these slides after the webinar is closed. Thank you so much for attending. I hope it was useful for you all. Ayaz and I were honored and delighted to participate in the first of what we believe will be a long series of these webinars, and we look forward to working with you all in the future. Many thanks indeed, and goodbye.
Thank you very much.